Very good morning, friends. Today, we at Bharadwaj Institute are coming up with a marathon session for CMA final who are planning to write their exam in December 25. Bharadwaj Institute serving CA, CMA, CS professional for more than 20 years, coming with their social responsibility or a socio-education responsibility with a marathon and other exam preparation strategy from the beginning of the institute. Now, as a continuing to that, this year for December 25 exam, we are coming with both CMA, intermediate and final, all the subject marathon for you. So I am very happy to deliver the first marathon in CMA final SFM today. So a lot of friends will be waiting. What is the plan for the day? Let me give you very clearly how we are planning this marathon session. See, first of all, I want to announce you that our institute has released a model question paper for your December 25 exam of final, and our SFM one question paper also released it. I want to tell you that this is the same pattern what we are following previous exam. That is 15 into 2, 30 mark MCQ, the same pattern, same weightage. Similarly, 5 out of, that is 7, 5 out of 7 we have to rate. Similarly, 7 mark question. So this is how the institute is going to release for you, friends. So that is very clear, and even 8th question will be a theory. So the same format how this exam are conducting. And let me tell you, there are some chapters like options, futures and forward and all. Previous year questions are keep on asking. So let me tell you, in this marathon session we were planning to give you the exam perspective knowledge plus conceptual knowledge also. So if you are very strict to practice on exam related question, first thing you have to do is that you have to revise all the recent previous year question of new syllabus, because minimum 2 questions they are keep on asking from recent previous year question. So please, 22 syllabus, all the previous year SFM previous year question, please practice 2-3 times minimum in your revision plan. Now let me give you, we were already come up with the separate exam strategy on SFM. So I want to come up again, but let me tell you an overview of this induction we have discussed earlier. You have a highest weightage is Forex 14 mark. So that will be given very good weightage in our session. And forward and options, that is also 14 mark weightage. That will be given very good weightage in our option. Another one area, equity and bond valuation, that is also will be given. And I would like to tell you that this is mostly coming from CA previous year question and CA practice panel. So in that video also I am going to explain you how the questions are coming from CA. Few CA questions are going to discuss. Another very important point is called portfolio management. This is also we are going to discuss. So these all important weightage are going to focus on our today in this session of podcast or in this session of marathon. So please be ensured that we are going to share you the same. So be ready and prepared for the same. So this is the previous question pattern, how these questions are coming for each attempt. Questions are coming for each attempt, each parameter. So we at Bharadwaj Institute, we offer CMA classes at all level, exclusive classes for the last 20 years. We offer classes on live mode, physical mode at our Chennai campus, and we also offer monthly subscription mode where you can be able to afford classes at a very minimal price. You can visit our website www.bharadwajinstitute.com, or you can be able to connect with our telephone numbers which is scrolled below. So my dear friends, we are going to start the session. So I am going to share you before that how this same pattern of MQP for December also. Same thing, they are coming with a capital budgeting question, then they are coming with one leasing question, then again they are coming with the risk analysis question, then they are coming with the shares, then bonds. So the same pattern only they are continuing. So this is how we are focusing on it. And in this marathon, I am clubbing all the videos relating to your exam so that it will be useful for you. So prepare very well. Give your suggestions in the chat box so that we can coming with exciting sessions in the coming days. All the best, my dear friends. So let us start. So I am going to club all my revision session exclusively for you through our Bharadwaj YouTube channel so that you can able to go with your December 25 exam with confidence. All the best. Yes. Now let us move to the first and most the important area, my dear friends, Forex. So hope all of you are ready. So as I indicated already, this is a marathon or a revision session for those friends who already know about what is Forex, what is international finance, all those terminologies. But anyway, for the benefit of everyone, I'm just giving a small revision of what you have learned in your Forex. See, any question of Forex or international finance, you should know some basic data. What are all the basic data you should know? Generally, currency may be expressed in a one-way code or a two-way code. What is meant by one-way code or a two-way code? One-way code means rupees per dollar. They will give 95. That means $1. That is per dollar. $1 95 rupees. This is what normal one-way code. But generally, majority of exam will have what 95. Then they will give bar 96.5. That means first one rate, another one rate. We call in our Forex, the first one it is called bid rate, second one it is called ask rate. So you should know about all these terminologies. What is bid rate? The rate at which bank buy the currency. What is ask rate? The rate at which bank sell the currency. Generally, always ask rate will be higher than the bid rate. Ask rate will be higher than the bid rate. This code rupees 95 per dollar. This is very, very important concept I am discussing. Any question now in Forex, next 2-3 hours, we are going to discuss this main point only. That is this expression, that is for $1. Any currency expression against 1 unit of foreign currency, we call it as direct quote. So this is what is called a direct quote for dollar. That is, which is one currency we call direct. That is directly you can able to understand what is the price of $1. Again, same way, if you take this way, if you take rupees per AUD. So what is the expression here? Here per a Australian dollar it is expressing. So we can say direct quote is AUD. These are all you know. Still, I just want to give you a small intro for you. Another one main thing. You want to know not what is for $1. You want to know what is for 1 rupee. Then what you have to do? We have learned that there is a math rule called if you want A by B, if you want A by B, A by B is not available in the market, then you can get it by a rule called 1 divided by A, B by A. This is simple logic. That is, you want to get the ulta answer. You want what is meant by 2 by 3. But you want what is meant by, what is the answer for 2 by 3? 2 by 3 is not available. 3 by 2 is there. So what you can do? 1 divided by 3 by 2, you will get the answer. So this kind of concept is you have to apply. So A by B is equal to 1 by B. So how can you get this 95 friends? This 95 if you want to get 1 divided by 95. So you can say what? Dollar. You can say that dollar per rupee, it is what? 0.0105. Now we can say it is direct quote for rupee. So which is denominator that is called. Sir, if in this example, I have one question. In this example, dollar is a direct quote. What you call for rupee? Rupee we call indirect quote for rupee. Correct? So generally, if what is the currency you're dealing, question, whether it is a hedging question, whether it is any type of question, they will tell you one point. You are an importer. You want to make a payment of $10,000. So that means your expression is at 10,000. That means you want to get dollar as a denominator. If it is direct, it is a direct quote, you can multiply. Suppose if in the case you are giving the data rupees $10,000, but the currency expression, the question is dollar per rupees. This everyone knows, but still some mistake will do. It's a basic intro. When we do problem again and again, you will become expert on this marathon. So you get dollar per rupees. When you get dollar per rupees, here we have the question is given $10,000. You have to make a payment. So $10,000 dollar is a numerator, so it is not a direct quote. So we have to do this strategy. You have to divide. So what you have to do? dollar 10,000 into 1 divided by 0.0105. You will get the answer. What is the answer? Let's see. 10,000 divided by 0.0105. You will get this. This you can do another shortcut. We'll do this shortcut. See, into 1 effect will remain same. So you can simply add 10,000 divided by 0.0105. You will get the same answer. So you can just divide it only. That is, if it is an indirect code, you have to divide. If it is a direct code, you have to multiply. Another one thing, this is if you are an exporter, you want to receive the payment also, whether you are buying or selling, not a problem. This currency only you will look into $10,000. The expression what is given. See, in this question, we are going to do in this marathon lot of questions. See, here they express this what? US dollar 250. So dollar you have to look into. Here rupees. So rupees you have to look into. Any type of question, if any type, all we are going to do. Here Japanese yen 1 crore. This is all we are going to do today. So Japanese yen 1 crore means yen we have to check here. So here look here, my dear friend, the expression yen is a numerator. So it is an indirect code. Here if you look into US dollar 250. Here rupees per US dollar. Dollar is a denominator. Here also, so it is a direct code. But look here, here you want. So don't look into what is where to pay, what to sell. That we will discuss when you do want to take bid and ask. But coming to this area, we have to go directly the point. Are you clear, friends? So US dollar 2 lakh 50, 50 lakh. You will get the data very easily. Are you clear? Good. So now what I have to tell you for you that we have to proceed to the next point. So you are, I hope all of you are getting clarity of this point very well. So what is bid day, what is asked? And similar to this, one more thing you should be able to understand that you know already, but still you should know about already. See, you want to know the, if in the same case, this case, how you will make it. Everyone know, but still let me give a small idea. See, 95 or 96. So if you want dollar to rupee, that is, if you want dollar to rupee, what is speciality, friends? Here we have a math rule. If you want A by B bid, if you want A by B bid, I will tell you, friends. Let's say a simple number will take rupees per dollar. Okay. Rupees per dollar, let's say bid 40 rupees. Ask 50 rupees. So we know always will be ask will be higher. Now we want to get ulta dollar per rupees. Generally, what we'll do, we have to divide. Now I am going to divide 1 divided by this bit I have divided. Ask also I am going to divide. Okay. Yes, we have that right. So now let's say, which is lower number, friends? 0.025 is a lower, 0.02 is a lower. Yes, you are correct. This is the lower number. So lower number only bid, higher number is asked. This you have already learned. That is because of the maths effect. When higher number is divided with 1, it will become lower number. Lower number is divided with a higher number, it will become higher number. So because of the reason, as all of you know, if you want A by B bid, if you want A by B bid, the formula is 1 by B by A ask you have to take. That is, if you want to bid there, when you are dividing, you have to take the higher number. The reason is what? See, we are getting a lower number by multiplying the higher number only. Same way as everyone know, but still I am telling, when you say indirect code. Direct code, this concept not at all there, you can directly take. When you have A by B ask, when you have A by B ask, what you do? 1 divided by B by A. With this kind of concept, you have to take it, kind of friends. So this is how we have to start, my dear friends. Now we have a lot of other concepts, appreciation, depreciation, everything will practice. So you know, appreciation, depreciation, two ways there. See, if it is, this is, if you want to get in this case, dollar, the dollar is a denominator, then appreciation normal formula, forward rate minus spot rate divided by spot rate into 100. If it is an indirect code, either we can change, or in the regular session we have discussed a shortcut formula. What is the formula, friends? Just a reverse calculation. Spot rate minus forward rate divided by forward rate into 100. So these kind of concepts you should understand. Then current spot rate by swap point, how to find out forward rate. All these technical terms you should recall. If any friends if misses anything while doing the problem, we will discuss, because it's a marathon session and we have just 10-20 days before our exam. So I don't want to make anything delay for you. We want to make it maximum sum to practice. And as I informed in the previous introduction session, we are going to do all the previous year question only. Maximum previous year question we are going to do, and also recent MQP for your benefit. So we are straight away going to the problem. so that you will get the answer. And we are doing the previous year question, friends. So question number 2. So what is question number 2, friends? Question number 2, similar to your study material question also. This came for your recent December 24 exam. 82.25, 83. So just now only we discuss appreciation, depreciation. So majority you might have been read the question. We don't want to take much time on reading the question. So what percentage dollar is changed? Analyze the nature of change. Nature of change means appreciation or depreciation. So let's start, friends. So how can you start? First one. Let's start. Yes, one main point is answer with reference to ask rate. So they're asking you to do only for ask rate. So let's start. So what is the rate, friends? You have to take the sport ask rate. What is the sport ask rate, friends? Sport ask rate. Ask rate, you have just now told the second one. This is the higher one, 82.5. So $2, so directly per dollar only. That is per dollar if they ask denominator. So directly we can take. So 82.5 is a direct quote. Next one it is forward ask rate. What is the forward ask rate we are getting, friends? 83.5. Sorry. Now we can go for our formula appreciation or depreciation. What is the formula, friends? Forward rate minus spot rate divided by spot rate into 100. So forward rate is 83.5, spot rate is 82.5. We have to apply. For me, since I am using Excel, just make it. So I will get the answer. Now I am getting positive. Positive means what? The effect is what? Appreciation. Positive means what? Appreciation. Now I have to go for next step. Here I have to do what is the rupee change rate with reference to bid rate. This is very, very important, friends. They are asked to with reference to bid rate. Now, coming to the point of bid rate. Yes. So we have to go for rupee perspective. So before that, my dear friends, if you want to do annualized, we can convert into annualized also. We can convert into annualized also. This is for 3 months. So what we can do? This is for 3 months. What will be for 12 months? You can show that way also, friends. Now we can go for appreciation of rupee. Rupee very important. They ask reference to bid rate. See, we will do shortcut which we learned in our class so that we can save a lot of time. See, if the rupee is asking, rupee is a numerator, that is an indirect code. So if it is an indirect code, there is a formula is there. Appreciation, there is a formula is there. I am repeating once again, my dear friends, which is called a spot rate minus forward rate. Spot rate minus forward rate divided by forward rate into 100. This is the indirect code formula we can do. So here we know very well what is the spot bid we can able to take very easily. So let's start, friends. Yes. So what is the spot rate? Your spot rate is 82.25. So here we have a very interesting point. They're asking to find out on the perspective of bid rate. So rupee bid rate means ask rate only. So we can able to work out on that perspective also. So first we will do both the perspective spot rate. So we'll go 82.25. We'll go our normal method. It is 82.5. We'll go ulta method. That is indirect method only will go. So it will be spot rate minus forward rate. Yes. So what is our spot rate? We will take 82.5 because ulta method divided by forward rate is 83.5 divided by 83.5 into 100. So let's see what is the answer. This is for 3 months. So if they want to do annual, the question is not specifically discussed we have to do for annual. So but if you want, we can do for annual also. So this is how the This is for 3 months. What is for now? If you want on the bid perspective, we can do the second one also, which will be 82.25 minus, we have our forward rate, which is 83 divided by 83 into 100. Because when it is an indirect quote, the ulta perspective will change. So this will be how to make it. This is for 3 months. This will be for 12 months. So the question is asking for only on the perspective of bid rate. So this is on bid rate. So you can able to. Since specifically bid rate, if you want, you can eliminate this one also. Now, my dear friends, if you look into this data very well, it is very clear you are getting a negative. Negative means it is a depreciation. So very, very important point I want to share you, friends. That is, if it is positive, it is an appreciation. Negative, it is a depreciation, friends. So hope you are all clear. So please complete fast. This is how you can able to complete very easily. So once you completed, I will proceed for the next one. Once you completed, I will proceed for the next one. So I think since it's a revision session, I want you to practically practice. Otherwise, we have to lengthen our sessions. I don't want to prolong that. Now, before doing fourth, I will do, before doing third, I will do fourth first. That you will be able to get a simple category here. So what is the fourth, friends? The fourth, how many rupees a firm required to pay to obtain? So you want to buy, obtain you have to buy. You have to buy dollar. If you want buying dollar, bank is selling. The rate at which bank sells is called what? Ask rate. The rate at which bank sells is called ask rate. And you have to obtain when in the spot. So spot ask rate is relevant. Spot ask rate is relevant. So this you should understand. This is, you can just keep in mind. I am just making this for reference. So what is the total amount of rupees? What you will do? Total amount of rupees you will do. You want how much dollar, friends? You want dollar of what? 250 into $250 into. Now spot ask rate. Why ask rate? Because we want to buy, bank is selling, the rate is bank selling is called ask. Why it is spot? It is a dollar is a denominator. This is very important. The currency which is given here is a denominator, so direct way. So that is why we have read ask rate. So it is 82.5. We will get the answer, which is dollar 250 into 82.5. You will get rupees, which is 20 lakh 62,500, which is very easy. 20 lakh 62, that is 2 crore 6 lakh 25,000. Now we'll go for third. This is how beginning onwards I was focusing. How much US dollar to firm sell? Don't look that word. Look the expression. Here the expression is what? 50 lakh. So you want rupees 50 rupees. Look this data, friends. Rupee is a denominator or a numerator? Rupee is a numerator. Since rupee is a numerator, it is in indirect code. So you want to get, don't look dollar perspective. What is the expression here? Rupees. So rupees you want to get. So you want to buy rupee. If you want to buy rupee, bank is selling. The rate at which bank is selling, the rate at which bank is selling is called ask rate. When you want, after 3 months. So we want 3 month forward ask rate for rupee. Since dollar is a direct quote, rupee is what? Indirect quote. So what we have to do? We have to take, if you want 3 months, 1 divided by, this is how, 1 divided by, you have to go for what? You have to divide by the ask rate. That is, you want forward ask rate, but you have to take what? 1 divided by forward bid rate only you have to take, because it is coming ulta way. You have to go forward ulta way. So this is how you have to approach. So what is the amount you have to get? 50 lakh. So 50 lakh divided by forward bid rate. So forward bid rate is what? 83. This is the answer. I am repeating again. See, my dear friends, you don't look this dollar or cell at all. You have to think what is a currency expression is given 50. So accordingly you have to take. Clear, friends? So this is how you have to make it. So the answer is or. Come on, friends. Yes. Now we have a small area. This is very basically thing. I think you can able to compute. Assume US dollar 1 lakh in your current area. This is same our study material model. Number only changing. If you get 10,000 per annum, the firm encash now or 3 months later. So you have two option now. You have two option now. So what you can do, if you encash now, if you encash now, what will be the amount, friends? What is the amount available? Amount of rupees with you. If you encash now, you have what is the amount? Dollar 1 lakh. So, my dear friends, if you go for dollar 1 lakh, see, you have dollar with you. So, you are giving to bank. Bank is buying. The rate at which bank buys is called what? Bid rate. The rate at which bank buys is called what? Bid rate. So, when you are giving, now you are encashing. See that thing? Encash now. So forward bid rate, which is 82.25, you are converting. The amount equivalent to you will be what? 1 lakh into 82.25. This is the amount available with you if you encash now, friends. Similar question, our study material also we have. Now another point, if you encash after 3 months. If you encash after 3 months, you know very well, the currency will keep on changing. The amount available will change. The amount of rupees will be what? Same 1 lakh dollar only, but exchange rate will be. Here sport bid rate, there also bid rate only because you are buying, bank is selling, the bank at rate which bank is called ask rate, but it is later after 3 months. So forward ask bid rate, that is forward bid rate 83. So what is the amount will be, my difference? 1 lakh into 83. This is the amount, my dear friends. You get the amount called 83 lakh. Now there is a time value difference is there. This you are getting after 3 months. This you are getting immediately. So they said the rupee you can invest for a 3 months. So what you can do? You can take add interest because this you will get interest also because you are getting the amount beginning itself. So this is opportunity cost or opportunity return. So 3 into what is the percent? 3 by 12 into what is the percentage of return you will get? That is, if you get this amount today and if you deposit in a bank, by the end of 3 months, the amount will be 84 lakh. Here, if you do this at the end of 3 months, it will be what? 83 lakh. So, which is best, my dear friends? 84 lakh, 30 another, 83 lakh, which is best. So, you have best is what? More the amount, better the option. More the amount, better the option. So, you will encash now. Here you encash after. So, you will encash now. That will be the best option for you. So, you can give the comment. You can encash now. You can go with the comment. You can encash now. So this is how we have to approach, friends. Higher the benefit, better the option. Higher the benefit, better the option. So this is how you have to make it, my dear friends. See, please believe 7 mark question is over. See here, by giving more number of nodes only, but still it is 5-6 lane only. That is Forex time, comparatively lesser time only will take. Forex question, comparatively lesser time only will take, my dear friends. Now, with all your permission, we are going for the main area hedging, my dear friends. We are going for the main area hedging, my dear friends. So, are you ready, friends? So if you take any question of previous year exam, you can able to identify that 7A and we have 7B. We have two questions coming for exam 7A and 7B from Forex. Majority exam 7B is what? Hedging. So, my dear friends, today in this marathon revision session, we are going to do all the previous year hedging question, my dear friends, for you. And I am going to give you in this session. I don't have much time, but I am going to give you in the regular session. We discuss conceptually, slowly. Now, in this marathon revision session, I am giving you cracking technique for you on hedging. Any type of hedging question, whether it is money market, whether it is options, we are giving you a shortcut, friends. Hope all of you are ready. Hope all of you are ready. See why we want to do hedge, my dear friends. See the hedge, the concept simply I will tell you, my dear friends, very fast. For the benefit of everyone, I am telling you the concept very simply because I don't want to take much time on this. See, if it is hedge, the main reason is what? See, future is uncertain. See, if you are an importer, you want to get a $10,000. You want to get a $10,000. So importer means you have to make a payment. You have to make a payment 10,000. See, you brought right now $1 is rupees 80 per dollar. So when you brought the rate is what? Rupees 80 per dollar. So you are thought of what? Price is lower. domestic market price is very high, so you thought of buying from abroad. So you brought from abroad your raw material, 10,000 is the billing value. So what you will think? Generally, raw material, you want to make a production, it will take time for get your revenue. So generally, majority trade will happen through trade. There is an operating cycle period will be there. So you will request for a credit period. So you ask a 3-month credit period. See, when you ask for a 3-month credit, they will also agree for them it is a revenue. Now, what is the uncertainty in Forex? This is very, very important, my dear friends. After 3 months, what is the currency rate? No one can predict. See, you thought of that, you get 8 is a good price, so you brought it now. Because if you buy it now, 8 lakh rupees. So domestic, the price is somewhere around 8 lakh 25. So you are getting a 25,000 savings, because we know 25,000 savings is not a small savings. This is for one raw material. So we have n number of raw material in a year, it will be very big, because market increasing price is very difficult. So what happened? You brought it. Now, after 3 months, when you want to make the payment, you approach the banker, you tell the banker, please transfer $10,000. So they transfer $10,000. Then you realize that that day the exchange rate is somewhere around 94 per dollar. So how much amount will be gone from your account, friends? 10,000 you have to make it. For every dollar you have to pay 9,000. So you have to pay 9 lakh 50. See, if you brought from domestic 8 lakh 25 only, for savings of 25 you purchased from abroad, but now what happened? You have to pay, end up with a 95 lakh. So some friends will ask you, sir, why can't you go for a credit? You can pay cash. I told already, see, business you can't get the cash immediately, because it's a trade cycle. Raw material production has to happen, it has to go credit sales, then you have to collect, because the working capital issue will be there if you take, or else opportunity cost also will be there. We discussed in the last question, correct? So this is the reason. So this is the uncertainty. What happened? Future price uncertainty. So how to manage this? So Forex is a very good tool. So how to manage this? That is what is hedge, my dear friends. In our regular classes, we told that this hedging, if you do effectively, we can give lot of value addition for the company. Lot of hedging tools are available. We have forward contract are available. We have money market tool are available. We have options are available. We have futures are available. Futures generally we call currency futures are available. Then we have no hedging. That is, we will take a risk. That is also available. So these are all the 5 types. Exam purpose generally coming forward money market option. Sometimes they will ask forward money market and currency future also. Sometimes they will ask money market options and no hedging. We today with this special session we are doing all these method, my dear friends. We want to ensure that any type of question you are able to solve, my dear friends. So I know all of you are ready. See, this is, I am going to a simple session for you, a simple strategy. Actually, what happened is, there's a small technical issue. So what I'm trying to tell you for you that we are going to give you a shortcut method on this forward money market everything. And we are going to do all the question, my dear friends. We are going to do all the question. So I know you are ready. So we are sharing the forward. See, forward we can have importer or exporter. So I am going to give you a unlocking material for you on this hedging for your benefit. So we are going to give you a unlocking material. Actually, this is a small recordical issue. Otherwise, I could have been taken this. This is how now I am recording the second time, because there is a small issue in our marathon. So we are recording it again for the benefit of you, my dear friends. In the sessions when we conducted, this was small technical issues. I am making for you again recording purpose. So I am giving that shortcut now itself releasing for you, my dear friends. First of all, I want to tell you very simple point. Any question we are discussing now, we have 2 cases will come hedging. I told importer. Importer means you have to make the payment. If you are an exporter means what? We will get a receivable. So 2 situation will come. Question, any hedging question, there are 2 situations. It is a payable will be there, receivable will be there. So if it is a forward contract, whether it is an option, whether it is a money market, whether it is a no hedge, every area I am going to give you an unlocking strategy now, my dear friends. This unlocking strategy, any question you can solve, friends. This unlocking strategy, any question you can solve, friends. First one, it is when a forward contract, if it's a direct quote, we have discussed what is direct quote, my dear friends. What is direct quote? In this example, we have discussed that this example rupees plus US dollar. Dollar is a direct. So if the question is coming, you are on to make a $10,000. So direct quote. If you tell 10,000 rupees, then it is a indirect code. So if it's a direct code, then you have to take ask rate. The reason why you take ask rate because you want to make a payment. So you want to buy from bank. The bank is selling. The rate at which bank sells is called what? Ask rate. In the regular session, we went through conceptual session. Now we have 10 days is there. So everyone wants shortcut. So I am giving this shortcut for you, friends. So if it is a receivable ulta, you are giving to bank because foreigner will make $10,000 in your account. So you want to give to the bank and you have to get your home currency. So bank is buying. The rate which bank buys is called what? Bid rate. So payable, any type of things, ask rate. Receivable, any type is what? Bid rate. If it is a indirect codes or ulta very simple. If it is ask rate, 1 by bid rate. If it is a receivable, it's a bid rate, it is 1 by ask rate. Hope all of you are clear. Now we are going to discuss a unlocking session for options which you cannot find anywhere. This is the 4 situation options will come, and today in this night we are discussing all these methods for you, friends. So what are all the options method are there? First one, you have to check what is options. Options give you the right but not the application. If you want, you can exercise or you can lapse. So option, there are 4 type of question will come. So I hope all of you recall your options concept. So let us start. Questions will give you both put and call details. Question will give you both put and call detail. We need to select a suitable one. That is call option we have, put option we have. What is call option? What is put option? Call option will give you right to buy. If you want, you can buy, or else you can lapse. What is put option? That is, if you want, you can sell, or else you can lapse. So that question will give both call and put. See, I will show you a lot of questions. They'll give you both. So you have to identify which is suitable for you. The next day, question will give load size because in options classes, we might have learned that number of contracts. So the number of contract load size will be there. So we have to do it. We have our study material one question, good morning question, where you can get 17 contract or 18 contract. That is you're working for a lot size. So that type of question will come. Then question itself will give you what action to be taken. See, this is very interesting. One of the recent question you see here, question itself, they're telling that analyze the, or I'll just show you one of the recent question only. One of the recent question, they were telling in the question itself what action you have to take. Question itself, they will tell you have to go for exercise or labs. 1 second. Yes, here itself is there. Purchase European call option. That is question itself, they're telling you take purchase call option for receivable. Here, purchase put option for payable. This came for what? December exam. That is question itself will tell you what action you have to take. The next day is spot price on expiry is given. This I will take one question from my regular material. My dear friends, for your benefit, for this purpose, I will take one question from my regular material. If spot price is on expiry is given, then we have to check exercise price lapse or action will be taken. If not given, then we have to apply. This I will take that question, my dear friends, for your benefit, so that you will get a better idea for that. Okay, friends. So next is what? Money market heads. See, any money market question, this is the step you have to look, my dear friends. I will take a lengthy session, but I have to tell you this is a shortcut. If it is a payable, the amount of deposit in foreign currency we have to take. What is the amount of deposit in foreign currency? If and you have to convert it, because I will tell you the logic behind the payable or money market. See, money market hedge is what? See, exchange rate, you are having a big challenge. What has happened for 3 months? See, I made a sale or I made a purchase. Let us make a sale itself. I made a sale to US dollar. The customer told that 10,000 they will give after 3 months. So 10,000 after they give 3 months, the $10,000 any price can happen. So what I will do, say for example, I will take a loan in US. Today, I won't take a 10,000. I will take such a loan where loan with interest is equal to 10,000. Loan with interest is equal to 10,000. So once loan with interest is equal to 10,000, I will get 9,800. Let us assume. That is the reason I have told what is the payable here, what is the receivable plus interest rate you have to reduce the amount of foreign currency loan. So the moment I take a loan, what I will do now, I immediately now itself will convert into my home currency. I will immediately, that means future exchange rate will not get affected. $10,000, my dear friends. So if I want to get $10,000, what I will do? This $10,000 I will convert now itself. So interest I have to reduce. So balance I will get 9,800 rupees because I take 9,800 loan only. 200 I have to pay interest. So 9,800 now itself I will convert into my home currency. Let's say now 9,800. Now I will deposit this in a bank where I will get an interest of what? 50,000. This is my cash available with me after 3 months. Now after 3 months, that person will give me the amount. At the time, market rate is only 60 per dollar, but I don't have no problem. The reason is what? The moment he transfers the money, I will tell, wait. I have a loan there. You settle that loan. So loan 9,800 plus interest 10,000. So dollar set off. You have no effect of rupees. In your account already there is a bank amount. 10 lakh 30. That is your amount. See, now if you don't take the risk, what could be the amount you get? 10,000 into 60 rupees. You get only 6 lakh. Because of this hedging, you are getting what now? 10 lakh. So this is the strategy of money market hedge. Same way payable case also. Payable means you want to make a payment there. So what you will do now, after 3 months, if you buy dollar, price may increase. So risk is what you doing. You take loan today itself in your home country. Because if I take a 10,000 loan from India, after 3 months, 10,000 plus interest only I want to repay. I don't want to take any risk of what? I don't want to take any risk of this currency rate. So I will take loan today itself. What is the loan I will take for depositing to in itself? That is $10,000 if I want to make payment there. Some deposit if I make, I will get 200 rupees, but 100 rupees interest. So if I deposit 9,900 in US, if I deposit 9,900 in US, I'll get 100 rupees interest. So 10,000. So I will deposit 9,900. So what is the amount required for that? That is I will borrow from India. So what is my outflow now? My outflow will be what is the loan plus interest. Same way, if it is a receivable, what is my inflow? Here also the same thing. Here you will make a deposit plus interest. So this is the one line shortcut, friends, for you. This is how you can be able to make it. So here look, my dear friends, what is strategy? See, if you look here, where it is. Yes. If you look here, inflow will be what? The amount of foreign currency deposit plus interest. What is outflow? The amount of home currency interest plus interest. So this is the step you can do. If there is no hedge, you don't want to do anything at all. Are you clear, friends? Now we'll go for one additional question from our old syllabus 16, because I want to teach you what is effective foreign currency rate also given. So hope all of you are ready. Shall we start, friends? So with your permission, we'll start that type of question also, so that you will get a better idea of that. See, in the regular session, we discussed the n number of questions. So you can revise those questions also additionally apart from this our marathon session. Okay, that will be helpful for you. These are all previous year CFL. This is the question, my dear friend, 62. So very superb question. I know all of you are ready. I am also ready. G Limited is an Indian company, has a payable. So it's a payable case 1.2 after 3 months. Forward market, money market options, all these details are there. So this is 60 rupees per dollar, 68.25, bid rate 68.32, ask rate, rupees per dollar 69.85, here 69.00 only, typing mistake. Here borrow, I told you deposits borrowing now. So 6.5 borrowing rate, interest rate, everything is given. See here, the case one, we have discussed two cases. See, question will give you both put and call details. We have to select. Yes, this is the case. Call option with a strike price, put option. Then one more case we have discussed. If spot price on expiry is given, we have to check is yes, spot price on expiry also given. So that is a standard question. That is the reason I have taken this question, my dear friends. This is the previous year question came for 16 syllabus. So we have to do this. After that, we are going to do immediately our previous year question, December 24. Because I told you, I don't want to take any risk on hedging. We are doing all the hedging question for you, friends. We are doing all the hedging question for you. So let us start, friends. He has to make 1.2 million in 3 months. So payable. Payable now, we have discussed the shortcut already, friends. What is the shortcut? If it is a payable, direct quote now ask rate, indirect quote now bid accordingly. We have discussed it. So we'll see here direct quote, indirect quote. See US dollar. So we have to make the payment in dollar. See the expression rupees per dollar. That means dollar is a denominator. Dollar is a denominator. So if it is a denominator, direct quote. So we are lucky. So forward market, they given forward rate already. Bid, ask. So payable, what you do? Ask rate. So what is the answer will be, my dear friends? 1.2 million into 16N. Answer is ready. 1.2 million into 16N. So your forward one line answer is over. So 16N, not 16N. Your forward ask rate. Yes. 1.62 into 16N. Your one line answer is over. 1.2 into 16N. Answer is over, friends. Hedging question we can finish in 5 minutes. Next we will go for what? Money market. Money market answer over. What is money market answer, friends? You are payable. So payable, we have discussed the shortcut. What is payable? Payable amount of deposits. So you have to make such a way payable plus interest. So what is a payable? See our payable. Let's see. Let me just go through what is a payable amount. This is the payable amount. So 120. Interest. What is the interest, friends? So you have to make a amount of deposit. You have to make a deposits. So foreign currency is what? Your dollar only. So deposit rate there. What is the rate, friends? Deposits. US dollar deposit is 6.5. How many month? 3 month. So 3 month deposit rate we have to check into. See your 6.5. Your 6.5 into 3 months. So 3 by 12. It is 1.625. You have to divide 1.0. This is one is a principal amount. So 1 plus. This is a in percentage. You have to do decimal. So 0.1625. You get this data. So if you do this, you will get the answer. What is the answer, my dear friends? 2 line, the answer is over. So the amount of deposits payable. This is the amount deposits. So you this money you want to take a loan today. So what is equivalent amount? You want to buy it from a bank. So if you want to buy, because you want to get the amount in the deposits you have to get. So what is the rate is required today? That is why I have mentioned here spot rate. You have to get it today, spot rate. So you want to get it from bank because you want to deposits. So bank is selling. The rate at which bank sells is called what? Ask rate. The rate which bank sells is called what? Ask rate. This you don't want to mug up. I have already told you. I have already told you. Ask rate only. Ask rate only. So don't need to think always. But if you want, you can think it because it is my style to thinking conceptually and repeating again. So ask rate. You want to get it. So it's now in dollar only. So you have to take a what is the ask rate now? What is the ask rate now, friends? Your ask rate now is 69. 3 month ask rate is what? 69. That is sport ask rate is what? You want to get today only, na? So 68.32. How interesting answer is over. So this is the amount you have to pay to the bank because you are buying from the bank, you have to pay. Now, what is your amount? Loan plus interest. I am going to complete in 1 minute, friends. What is your loan rate? You can take the loan rate. Now you are taking loan in India. Here also mentioned in the home currency. So India, you are taking a loan. See, loan, borrow, 16%. So 4 months, it will come 3 months, it will be 4%. So for me, one line answer is. See, this answer is over. Believe, my dear friends. So this is how we have to do 83 lakh 89,000. See, this is I have taken. See, I have taken details also. Small recording error. I am just making it. See, 83 lakh 89 answer is over. So this is how we have to approach, my dear friends, whether it is a, see, money market question, maybe some friends, lot of things, nothing is there, only this lane, that is payable, receivable, these steps. See, I have done this. In our regular session, we have discussed detailed action now, action on maturity, action now, what is the amount, what is deposits, the action on maturity, because that is conceptually I want to give. Now 10 days is there. So if you want feeling this difficulty, you want to know shortcut, let us know, learn it, my dear friends. Because I want to make you, all of you are cracking the maximum mark in our SFM. I want to make any forgot on that. Now we'll go for the next point called the call option. Here the point they given both call and put, my dear friends. So we will continue with the options now. So options very interestingly, as I discussed it, we have to check with the case. What is the case we have to check? Whether the expression is given what perspective. So if you gone through this question, US dollar is given and the strike price also dollar is given. So what you want? You want to make payment of dollars. So means you need to buy the dollar. So if you want to buy the dollar, bank is, so if you want to buy, call option or put option is relevant. You have to buy a call option. You have to buy a call option. So you have to go with call option. Though the question call and put is given, dollar you want to buy. So you have to go with a call option of dollar. So what is the amount? 69 is the strike price. So you have to check for each price. The premium also you have to pay. So how you can able to go for it? You can go for it each case. What is the spot price on expiry? Your spot price can be 68.4 or it can be 69 or it can be 69. So you know your exercise price. Your call option exercise price is what? 69. Call option exercise price is what? 69. So you have to check what is your action. What is your action? When we are going buying a call option. So when the market price is 68.4, will you buy at 69? No. So you will lapse. Then what you will do? You want to settle, you will buy from market. Here either exercise for lapse. When market is 16.6, yes, you will buy at 69. Now, what is the outflow? Your outflow will be, you want to settle an amount of what? $1,20. For that, you have to multiply with what? Laps. You will buy from market. Market, you have to pay only what? 68.4. Coming to here, here again, 1,20,000. You will buy exercise or lap, same effect, so 69. Here you will exercise, you have to pay 69. So this is the amount. Apart from that, you have to pay a premium. What is the premium you have to pay? Premium you have to pay every $1.1. So 120, this is the dollar you have to pay. So 0.1, this is the amount. So what is our total outflow? Total outflow will be this, both you have to add. So there is a probability is there. So what is the probability? Why probability? Because three price, it cannot be three price now. So 0.1, 0.6, 0.3. Total of the probability must be 1. So you can get expected outflow. So now you can able to go with this option. So this is the expected outflow under call option. See, my dear friends, at a one look, you feel that options are over. See, you won't buy a put option, obviously correct. But you can be a seller of a put option, another option. This is very interestingly the reason I choose this question. You put option you can't buy because if you buy the put option, you have to sell the dollar. So you don't want to sell the dollar because you require the dollar. So you can be a writer or a seller of a put option. That means other party will sell the dollar to you. See, if other party selling the dollar means you are buying the dollar. That means you can go with another option. So in the regular class, we have discussed it. If you want to buy anything, you can go with a two option. One is you can become a buyer of a call option, or you can become a writer of a put option. So the same thing what you learned in your regular class, you can work out it. So what will be the case now? Selling or writing a put option. I hope all of you clear on this logic. Yes or no, friends? Writing a put option. So again the same case, spot price. Here put option perspective only will work it. What is exercise price, friends? Your exercise price is here also 69 only. What will be the action? See here, you don't think action in your perspective, the person who brought the put option. When the market price is 68.4, he can sell at 69. So will he sell or not? Yes, he is getting a higher number, he will exercise. Here, either exercise or lapse. When market price is 69, you won't sell it, so lapse. So what will be the outflow for you? Since he exercise, you want to buy at 69, so your amount will be 80 to 80. Here, same 80 to 80. Now, when it comes here, lapse. When it is lapse, you have to buy from where? Market. So market, what is the price? Higher price, because that person will not sell. He won't want to suffer the loss. So you have to get. And here, the premium is you are writing a put option. The regular class, we have learned that if you are a seller or a writer of any option, you will get the premium because other party has to pay. Because here buying, we add the premium because it's an outflow. But other person, it is an inflow. Yes, other person is what? Writer. So he is getting a premium. So what is the premium? 0.05. So 1,20,000 into 0.05. So this is the amount. So you have net outflow. How can you get net outflow? This is your outflow, but you are getting a premium. So that is over. Now same probability, same thing. You can just go for it. Outflow, we have to multiply. See, now tell my dear friends, where is the lower the outflow? Here 82. Better always you have to prepare a table. So table under each case you have to prepare. You have to make outflow under each course of action. What is the outflow under each course of action? One is forward, another one is money market, another one is buying a call option, writing a put option. Correct, friends? So what is the amount? Forward this amount. Here we have this amount. So which is the best one, friends? The lowest outflow coming still under forward. So your action will be what? Go with the forward option. So hope you are here. So this is how we have to approach. Hope you are here. So let's continue the session, friends. Now we'll go for another question. So before that, let us revise what are all the option case we discussed. We discussed a 4 model of options. Correct, friends? In that, first two case we were discussed. There is question both put and call given and in expiry. Now we will go with a question of load size. See, actually, there is no previous year question came on load size. But this load size is very important. Your ICMA steady material having a one question with load size. Your ICMA steady material is having a one question of load size. So before starting with our previous year question, we are going with one question. This is the one question in your steady material, which may even directly come for your current attempt. So a very good question, which is also in our workbook. That is, we are going with question number 44, a superb question. Here we have bid, ask, direct quote, indirect quote, majority twist also there, because in one session of revision, I want you have to understand all the scenarios of in this approach. So that is the main intention. We are going with this question. I know you are ready. I am also ready. So let's start question number 44. Good morning, limited. London have to make a payment of US dollar. So we'll go very fast. You might have been going through this question already. Since it is a revision session, we'll go to the point very much time. So they are given. See, you have to make a payment. So very clear, payable. Spot rate is given. See, they are given two rate. So you can understand this is one rate, this is one other rate, and also forward rate also given. For our money market, they given the details. See here, 1 unit of pound. See the point. Here they given for pound perspective. See, what is you require here? Dollar. But currency is given in pound. See, in the previous question, dollar is there. But here pound perspective. Because of that, your call option, put option will change. That is a point. So they were asking what is for forward market, what is money market, what is currency market. See, one unit, that is contract load size also given. So this will give you a clear clarity. And my dear friends, we will be, since we revise the shortcut method, we'll be able to solve within a very short time also. So let's start the game. We'll start with, this is our workbook question number 44. Your ICMA study material question also. So let's start. I will add in this material also. So let's start the game. Which question? Which is the first one? Forward. See, forward contract and all. See, it's a one line point. We discussed the shortcut method. Payable. Can you just check the table and tell me payable? What is the shortcut we have discussed? See, one simple point. We can go proper also. Payable direct quote now ask rate, indirect quote now 1 by bid rate. So we'll see the case, what kind of case it is applicable here. So I know you are ready. Let's start. So how we will start? See, we have to make a dollar. See, what is the expression they have given? They are given expression called a dollar 1.5617. That means dollar is numerator 17. This is per pound. It is implied. Dollar is given numerator. Per pound is not expressed, but dollar is given here. That means your denominator currency is pound. That is the dollar which you have to make a payment is numerator, which is called what? Indirect quote. So indirect quote we have discussed. If you want ask rate, you have to go 1 divided by bid rate. So forward rate is given. So we can do very easily. So outflow will be what? You have to make a dollar 3,64,897 divided by, you have to do, you want ask rate, but you have to do 1 divided by bid rate 1.5455. 1.5455. So what will be the answer, friends? 3,64,897 divided by 1.5455. That's all. Your outflow you got under pound very easily. This is GBP. So you can put GBP here. So outflow under forward. See, any question forward will have weightage. So you can easily crack the same. Now going to next perspective, we'll go for what? Next point, money market hedge. We'll go for money market hedge. I know you are ready. So let's start. What is money market hedge? So it is payable. So payable, we have discussed the shortcut here. So you don't want to make anything. So last question also payable. So you have to make the amount of deposits. The amount of deposits. We are doing a very shortcut method. So what is the amount of deposits? You have to make an amount of US dollar 364,897. So dollar, US dollar, deposit rate 4.5, it is 6 month. So 6 month, it will be 1.0. 4.5 for 6 month, if I am not wrong, 2.225. So if you go with the amount of deposits will be what? 3,64,897 divided by 1.0225. You will get the amount. This is the amount which you will get in dollar. So this is the amount in dollar. Now you have to make in your home currency. So this is the amount of deposits. So same step, same shortcut. I don't want you to make the effort much. So amount of equivalent home currency loan. If you want to make deposits, you have to take a loan. So obviously, what is relevant? A spot rate is relevant. So you'll go with the GBP conversion. So GBP, how you will convert? See, we know obviously it is a ask rate, but it is a indirect code. So 1 divided by bid rate. So you have to go with, this is the amount in that indirect 1.5617. The reason we go bid rate already we know, we have discussed this table very clearly. You must be very clear on this. What is the point, friends? If it is a payable indirect code, 1 divided by bid rate. So logic also we have discussed in detail on that. So you got the amount. Next, the step, last step. What is the last step? So no need to make any effort, friends. You can make it very easily. So I want to ensure you have to. In the regular class, we have taken a lengthy method, but here we are doing very shortcut. So 228 512.19 into. So you are taking a loan in your country, that is UK. So loan 7%. So 6%, 6 months it will be 1.035. So this is the amount. So that's all. That number is over. See? So your outflow is ready. GBP 236,510.11. Hope all of you are clear. Clear, friends? Pakka? Good. Now we will go for the last perspective. See, this we have took now just 8 minutes after all this discussion. So it will complete within 10 minutes. Even I'm discussing the same. So you can complete for your exam 7 to 8 minutes time. Though in your exam 7 mark into 1.8, you have a close to 13 minutes are there. Now we will go for options. Here come the option. We are going with the case 3. What is the case 3, friends? Here question will give load says we have to work with the number of contracts. See here, I don't want to take much time for you. So we'll go with the options. So what is the case, friends? Yes. See, 1 unit is equal to 12,500. 1 unit is equal to what? 12,500. First, you have to decide whether you will go for call option or put option. See, you have to buy the dollar, but expression is given for pound. So if you want to buy the sell the put option, sell the pound, then only you will get the dollar. So dollar, they given pound perspective. So pound perspective only you have to think it. We have discussed because the expression here it is dollar. In the previous question, dollar is expression dollar. So both are same. We told buy a call option. But here we don't have that case. What is the case here? We have dollar and we have here pound. That is dollar and pound. So not matching. So you have to think what is the currency here? Pound. So pound perspective you have to think. If you want to get the dollar, pound you have to sell. So you want to sell the pound. If you want to sell the pound, it is a put option. So right to sell. So the relevant is what? This is the perspective will come put option. Excess price, both the case one price only. One pound is equal to 1.7. So you can get the number of contract very easily. So before that, let me tell you, see this illustration will give you clarity of this concept also. What is the clarity of this concept? That is spot price on exercise price is not given. In the last question we given. If not given, we have to apply that is it is exercising. This is the case. In such a case, that case 2 will not come. In the previous question we have did that buy a call option. There is a one more strategy, sell a put option. That will come only when there is a exercise price on, that is spot price on expiry. If spot price on expiry, second method will not be there. You will have only one action will be there. That is either buying a call or buying a put. Any one only will be there. You can't do both the action. You can do both the action only when expiry price is given, and that can be done accordingly. So in this case, answer is over. So we can able to proceed it. So what is the number of contract here? So what is the value of one contract? Value of one contract is, we have GBP 12,500 for everything. You have access whatever may be the market price. For 1 GBP you will get $1.7. So $1.7 if you are getting 12,500 into 1.7, you will get $21,250. So this is the amount in dollars. This is the case in dollar. So this is the case in US dollar. This is the case in US dollar. Now what you have to go? Number of contracts. That's all. So already we discussed in our regular class. So I want to discuss this perspective only. Balance its normal case. So number of contract will come what? You have to go with a 3,64,897 divided by 21,250. This is will the case will come. So what is the contract? It will come 3,64,897 divided by 21,250, 17.17. My dear friends, you cannot go 17.17 contract practically. So either you have to go for 17 or 18. Sir, what I have to do? Do I want to go for 17 or I have to go for 18? My dear friends, here you have to go either 17 or 18. If you go 17, the amount will be insufficient. So balance amount, you have to get it from the forward contract. If you go with 18, you will have excess amount that you have to sell in the forward contract. That's all. Answer is over. The put option exercise premium also given. So what will be the case for 17 contract? So I don't want to prolong this discussion. It is your study material question. I want to revise this concept. That is why I have discussed it. So if it is a 17 contract, I am telling the point 17 contract outflow will come 17 into 12,500. So case 1, 17 contract. So we can go for 17 contract. If you go for 17 contract, what is the outflow for contract, which is 17 contract, each contract 12,500. So it is in GBP 17 into 12,500. So the problem in 17 contract, you will get 17 into 12,500 into 1.7. You will get only this much. Balance money, you have a shortage. You require 3,64,897. So there is a shortage of 3,647. So this 3,647 shortage, this you have to get it from the forward market. Same thing. You want to buy bank is selling, so ask rate. So forward ask rate, but the rate is not there. So what you have to do? So you have to get balance through forward contract. So what will happen now? You will have to get this amount, that is 3,647. It is indirect code, so divide by. Already we divided the same number. Here it is a spot forward rate only. So say 1.54. Both are buying. If it is selling, you take ulta rate. But here you can take directly the rate. So 3,647 divided by 1.5454. So you get this number. See how easy. Now one small one point you have to make it. That is none other than your premium for 17 contract. What is the premium you have to make for 17 contract, friends? For each contract, your premium is what? For every dollar, 0.096. So what is the total amount you have to make? 12,500 into 0. That is you are going with. Can anyone tell me the amount? 12,500 into 0.096 into 17 contract. What is the total amount? Sorry, 7,008 62.5. Correct? 1 second. It is getting 20,400. I have done already the total, but you are not giving me 20,400. So it is in dollar expression. So you have to make the settlement. So you have to make the premium when now spot rate. So you have to convert that 20,400. You don't have the direct. So what you have to do? You have to take the spot bit rate. That is 1.5617. 1.5617. 1.5617. This is the amount in GBP, because dollar you have to convert into GBP. So you get the number, friends. So this is the total outflow under 17 contract. Sir, what will be the change if it is an 18 contract? So this is the outflow under 17 contract. Sir, what is the difference if it is an 18 contract? That is obviously 17, instead it will come 18. Balance you will have excess. So the difference money, you don't buy it, you want sell it. So you don't take 1.54 bid rate, you will take the ask rate. Premium, the same perspective, you have to do it. Only instead of 17, it will be what? 18. So you can just post the video and you can complete for 18 contract. The same perspective only you can try for 18 contract. So you can just try, friends, for 18 contract. So this kind of questions will help you to boost your confidence. This kind of question will help you to boost your confidence. We want to ensure that you are completing all these questions. So once you done, we can go for what? 18 contract. So you have to take finally the table. All the 4 case we have to take, which is the best. So very shortcut method we have discussed it. So that a regular class we might have been going little lengthy, but I want to ensure that in the revision it should be very simple as it is. So we want to interrelate it very well. So please try for 18 contract. I have already given, instead of 17 we have to take 18. The balance money you have to get it. So it is not 3647, it will change. That is, it will be 18 contract. So you will get 17,603. That you have to divide it. Come on, friends. Let's see who will help me. You have to try. This revision session, you have to parallelly try. Then only it will helpful for you to understand. So you have to take and work out. So what is the answer for 18 contract, friends? So 18 contract. It will be 227,553. 227,553. So congrats for those who got the correct answer. So already I have told you the calculation. I have already told 17.603 logic, 12,500 logic. This is amount of premium we have to make it. So that's all. So now you can go for a comparative table. What is in by comparative table? You have to take the all the 4 case. So I am not preparing the table again and taking enough time. I'm not taking table and taking enough time. What I'm going to do, we are just checking which is the best. 18 contract 227,553. Here 227,992. Here it is under option 236. 236. So which is best? We get lowest is 18 contract. So we have to do for 18 contract. Some friends will think that we won't go for 18 contract, we'll go for 17 itself. But among all these things, because here 227992 only, under money market it is 236, forward also 236. So here the lower one is what? Options only, because whatever maybe. So very important point is what? Here you are not going to compare with the market price, because market price on expiry is not given. If market price on expiry is given, only you have to compare whether to exercise or not exercise. If nothing is given, then we have to imply that we are exercising. So hope you are clear the logic. So you can able to recall all these concepts with this discussion of two questions standard. So this question, a very good question, you can even expect for your exam. Now we will go for December 24 question. Hope all of you are ready. Once you complete for 18 question, we'll proceed, friends. Hope all of you are ready. So a very good question. A reason previous year question. So before going to this reason previous year question, I want to ensure that all of you clear about your study material one question, which is also a MQP question. I'm not going to solve this, but this is your study material question, which is also MQP question for June 2025. The May month last week, that is recently, they uploaded set 2 of SFM. So set 2 of SFM question only. This is ditto from your study material. So I want to revise this concept, then we can go for that derivative. That is the question on what? Hedging. So what is this concept? There is a concept called netting. What is meant by netting, friends? See, we have an uncertainty. You have to make a payment of $10,000. You have a receipt of $8,000 also. That means $10,000 payment, 8,000 receipt. So no need to go for 10,000 hedging for payment, 8,000 hedging for receivable, because both are same currency, only dollar. So what you can do? 10,000 payment, 8,000 receivable, netting of both. So net amount will come what? 2,000. So that 2,000 amount you can go for what? Hedging. This is what is called netting. See, this is your sedimentary equation, also MQP set 2. I'm not going because it's a general question, you can able to do very fast. I'm telling the answer also. Once this done, then we can go for that, because you will understand the concept of netting. See, you have a 40 lakh inflow, 20 lakh outflow. So what you will do? You make the netting of. That is our inflow, outflow you will make. So your net liability will be what? 4 minus 2, it will be 2 crore. Similarly, 2 and 80, 1 crore 20. 3 minus 2, so 1.2. 1.5 minus 2.5. So you will get what? 1.5. So this kind of exposure you can able to get it. So how can you do? You can express with your spot rate. So what is different? You can, or you can make the difference in spot rate. Spread you can multiply. Then here they're asking any exposure is offsetting. Yes, because here 48.01 increasing. So all this will have positive. But here 3.2, 2.4 negative. Here also inflow, outflow negative. So negative, if you multiply, you will get what? Positive. That is the meaning called what? Netting off. That is the meaning called what? Netting off. So hope your concept of clear for that netting off also. This is your ICMA study material question, and also MQP set to 2 question. So if anyone want to just recall, since I started discussing, if anyone want to recall that question, I'm just sharing the final answer also. That is, you have inflow, you have outflow. So you have to take the net of the same. You have inflow, you have outflow. You have to take the net out of that. So we are going for the hedging question, so that we can get all the recall very well. See here, 40 lakh, 20 lakh, net will be 20. The difference is what? 0.81. How you got 0.81? This is the answer. So if ditto MQP coming, you can able to score 48.01, 48.82. The difference is called what? 0.81. So it is positive. Now all these got it. Here 15 minus 25 you will get minus 10. Here also minus. So minus minus you will multiply. You will get what? Positive. That is what? Is there any offsetting is there? Second part they are asking. If there any offsetting is there. Yes. Japanese yen. That is. So first step you can do on your spot trade. First step, if it is MQP ditto question is coming, first step you can do for what? First step you can do for what? Spot trade. Next you can do for spread day. What is spread day? Spot and forward difference. So clear friends, though I discussed very short, I hope you are clear on this netting off concept. Netting off clear. So netting off means what? You have an inflow, you have an outflow, you're adjusting the both and you are taking the hedging for the balance portion. With this, we'll go for the revision question. So I know you are ready. So we have to go for the first question. See, this is a lengthy question, very interesting question. This is a previous year around 10 mark question for CA final or CMA final also, very longer period. But now it is came for 7 mark. That is the time issues we have. So with your permission, we are starting. Atonex Limited is an Indian company that export precision equipment, has a foreign receivable of euro 25. So see here, receivable of euro 25 million due in 6 months. Simultaneously, the company has an upcoming payable of what? 10 million in 6 months. So they have receivable of 25, payable of 10. So you quote. And what currency, friends? Euro. It's an Indian company. So your home currency is rupee only. Company is evaluating 3 hedging strategies. My dear friends, they're asking 3 hedging strategy. First one it is forward rate 97. Though it is a lengthy question, one advantage we have is that they are not given two-way quote. We discussed two-way quote previously, bid and ask. Here, that kind of twist is not there. Only one currency, that is Euro 97. This is both for receivable, payable, one rate only. Then money market hedging, borrowing, deposits, right, and all they given. Currency option also they given the clue. Then here, see here, Euro 95. Expected spot rate after 6 months also given. So you have to go with the decision with what? Exercise or lapse, then only you have to take the decision. Analyze the forward contract hedge strategy for both receivable and payable. Then analyze the for the money market strategy for both receivable and payable. Assess the outcome using currency option hedge. Stabilize the result from all the 3 hedging. That will be just recommended best strategy to minimize the net exposure. So the main point is what? Very sad thing it is what? Forward for both receivable and payable. So you have to do for receivable, you have to do for payable. Finally, only they are asking for what? Net. Finally, only they are asking for what? Net. So shall we start? So we will do very shortcut because we learned the shortcut method. So though it is a December 24 previous year question, we can do in a shortcut method. We can do in a shortcut method. First, we will go for forward contract. So we have inflow. We will use the term what they used, receivable. Shall we start, friends? We can do in 1 minute. We can do in 1 minute. So receivable. See, 25 million. So it is euro. See this point? Euro. Your transaction is euro. Denominator also euro. So it is a direct quote. Direct quote, directly we can multiply. No need of dividend. So what you have to do? You have receivable 25 million. See, forward. Forward rate, both receivable, payable, same rate only. So 25 into 97. You can simply just return one line called a million. And here it is what? 10. So 10 into, again the same thing, 97. You got million. So what is a net exposure? So this is actually your exam perspective. If you are written, this is the first, you have to return not this way. You have to return how first they're asking analyze forward for both receivable and payable. That means Up to this only will come first part. I am doing net here. This is you have to do finally. So shall we do discuss shortcut method or we'll do exam perspective step? Exam perspective na net you have to do later. So this is the only step. See, if you look into my board, you can able to see that directly we are going for the answer because we are good in concept. Exam you can just show the working. You have to just multiply with the 97. You have to just multiply with the 97 because we have to do for all the case. That is the reason I am doing like this. Is this presentation okay? Fine. So we are done, just multiplied because a direct quote. Now we can go for what? Money market. So first we'll go for what? Receivables. For me, receivables or payable, our theory we have here. So this is the theory we have. Copy, paste. That's all. So what is the point, friends? The amount of foreign currency loan. So you have to get a euro only. So you have to take a 25 million loan. So the amount of foreign, so loan, euro borrowing rate is 3.5. So you are going for a 6 month. So 3.5, if you go for a 6 month, it is 1.75. It is 1.75. So what will be the amount will come? 25 million divided by 1.0175. This is the amount of foreign currency loan. What is the equivalent amount? So it's a direct quote only, receivable only. So receivable, we have our shortcut table, no need of taking any effort. So we have receivable direct quote, you have to go for what? Bid rate. We know why, because we are giving to the bank, bank is buying, that is the logic. So logic also with us, but we can do here. So what will be the amount? You will go with spot rate. So this amount you have to multiply with the spot rate. What is the spot rate? Current spot rate is 95. See here, current spot rate is what? 95. So this is the amount you will get it. Now, what is the inflow under money market? This you are going to deposits. So if you deposit this amount, 2334.153 with interest. So what is the deposit rate? 7. So 7 na 1.035, you will get this amount. So this is the amount you will get it. So 2415. So hope you are. So very easily we can able to complete for receivables. Now we can go for payables. So this is for receivable. How can you go for payable? Same our steps. We have discussed the shortcut for payable. Payable, we did lot of question. Now you might have been expert. So here you are going for a deposits. So what is the amount? We have 10 million we have to pay. So what is the deposits rate? We have to go 3.5. That is also 3.5. So 1.0175. So 10 million divided by 1.0175. Now coming into amount of equivalent home currency loan. So payable now, you have to take the ask rate because you have to make the money, buy the money. So, but here there is no ask rate, bid rate at all. All are one rate only. So no need of confusion. There is no ask rate, bid rate and all. So only one rate. So amount of home currency loan and interest. So you can get it. 933.6 into you are taking a loan, so 9%, 1.045. That's what answer is over. So this kind of strategy will help you to solve very easily. That is the reason I have discussed the shortcut. Hope you are now well clear on this method. Hope now you are well clear on this method. So we did now money market, receivable, payable, all these perspective. All of you clear, friends? Here, shall I proceed? Shall we proceed now? So hope all of you clear. So this shortcut method will save lot of time, friends. This shortcut method will save lot of time. Now we'll go for the last method. What is the last method? Currency option. See, currency option, this question now, currency option. So option, now you are expert because we did all the different method. So there is a problem in options. There is a problem in option. The problem is nothing but the question itself is given what strategy. Actually, this strategy is not correct. If you want euro code, you should not code receivable. But they given this strategy itself is wrong. See, you want to receivable, you want to give the euro, but they're telling you will go for call option on receivable. So logically, this question is wrong, but we are helpless. Specifically, they said that you go with a call option. So we don't have no other option. We have to go for it. But we can go one thing. As you know, strike price is given, market price on expiry is given. So you have to compare and you have to take a corrective actions. Because if it is in the money, you will exercise. If it is out the money, you will lapse it. You will go with the market. Correct, friends? So we'll go for currency option. So there's a technically one wrong here, but anyway, we'll go for it. So first we'll go for receivables. First we'll go for receivables. Obviously, the first one will be the premium. So what is the premium we have to pay? They said very clear, we have to pay rupees 2. So already in rupee given, for every euro, you have to give 2 rupee. So how many receivables you have? 25. So receivables 2. So they have already given, you are going with a call option. For receivables, they said very clear, you are going with a call option. So no need to worry on which option and all. Generally, all the question we done now, we only identified which option. But here in the question itself is given, you have to go. So premium will be what? 25 into 2, which will be what? 50 million. 25 into 2, it will be what? 50 million. Next, what is the amount? Here you have to compare it. See, you are buying euro, correct? because it's a call option you are buying. So you can buy at 98, which is the strike price, or 99, which is the price expiry. That is spot price on expiry. Now tell my dear friends, €1 you can get for 98 or you can get for 99. Which is best for you? 98 is best or 99 is best? What is the point? What is best? You have to be very clear. You will get €1 if you give, you will get 98 if you exercise. If you lapse it, if you give €1, you will get 99. It's a receivable only. We have to think receivable perspective. I thought of it in payable one moment. So let us rethink. If it is a receivable, you have euro because you are getting euro in your pocket. So this euro, if you give to the bank, this euro, if you give to the bank, they will give you two options, 98 or 99. Which one you will choose? You will choose 99 only because you want more rupee. So what will happen? The action here will be lapse. Action here will be what? Lapse. So you will get 99 only the answer. So this is the perfect answer. Already I told this question technically wrong. So you don't look into the suggested answer perspective. Suggested answer also wrong only. So this is the way perfectly we have to solve it. So you get 94 points. So this is for what? Receivable perspective. Now we have to go for what? Now we have to go for what? Payable. Payable, we will think. Payable only we discussed earlier. Lower the outflow, better the option. So we go with what? Put option. We go with what? Put option. So what is the first case? We will go for it. First case we will go for premium. So you have 10 million only. For every 1 million, you have to pay for what? 1.5. So what will be the point? You get this number. See? Now you have to go for it. Your strike price for put option. What is the strike price for put option? You can go again 90, or here it is 95. Now tell my dear friends, you can sell for 95. 1 second. So put option. See here it is a receivable. So 2475 you got it. For that you paid a premium of 50. So premium is a outflow for you. So I haven't put that negative here. So you have to put the negative. So you will get a receivable of what? 2425. We discuss it properly, but we haven't added because of the formula page. We added both together. So it is a outflow. Outflow means it is a negative. So negative and plus you have to take a net effect. Now here we'll go for last one, payable option. So payable option, first perspective, premium. Hope all of you are clear. Now we'll go for the second case. We have to go. So your exercise price is 95 is the strike price, or 99 is the expiry. See, you have to pay. Tell my dear friends, €1 you can get for 95 and another shop it is 99 in the market. So you will exercise only, because that is, if you exercise, you will get for €1 at 95. You will try to reduce your outflow only. Are you clear? You will try to reduce your outflow only because it's a payable. Payable, you try to reduce the outflow. So your action will be what? Exercise. Your action will be what? Exercise. So when you exercising, what will be the amount? Your amount is 10. 10 into 95. So you will get 950 million. So here what is speciality, friends? Here both are outflow for you. So both are outflow, you have to add. Because put option also, you have to pay the premium. Here you have payable. So both are outflow, you have to add it. So the amount will be what? 965. So my dear friends, the lengthy essay question, we done this much shortcut method. The lengthy essay question, we done this shortcut method. Now answer is not over. They're asking you to prepare what? Net effect. So net effect you have to show separately in a table. But what I am doing is, for time saving purpose, I am showing here itself net effect in each one. So you have to show separate table. What is a separate table? Receivable, payable, then net for forward everything. Or else I can also share you the suggested answer table also, so that you can able to get a better idea also. So shall I go for it? So, my dear friends, now what you can do, your forward contract 2525970. So you can just, I am just on here 2525970. So net will be 1455. You can just adjust this. So this is the comparison table. Money market, you have 2415975. So 2415975. Currency option I have already told, your study material is done little wrong. So we have done it correctly only. What is the wrong they have done it is, actually they have taken, instead of 10 into 1.5, they again converted into multiplication. Small error in the working note they have done. So that is why the answer is wrong in study material for currency option. That is nothing but, when you do the option premium, they have done INR 25 million. So actually it is not 25 million. It is 25 into 2, it would be 50 million. So that is a slight wrong they have done. Maybe copying the error case. Same here also, 15 into 1.5, they have to make it. So that wrong they have done. Similarly, this price also they make it in spot price. So we have taken already the correct answer. So this is the perspective. That is already I have told you that wording getting error. So this is how you have to present it. How the comparison table. So comparison table you have to present its currency option. I have already told it's a wrong point. So the best perspective you are showing, which perspective your net outflow is lower. Here you have net outflow, you are getting 1460, and here the net outflow is what? 1440. So receivable only. So higher the receivable, better the option. 1455, 1440, 1460. Which is best? Higher is the best. So currency option is best. Your answer is what? Currency option. Because receivable, payable, net is receivable only. So receivable is best. So this is how you can able to approach. So very interesting question. You can easily solve. A very interesting question. You can easily solve. So with your permission, we can proceed for next question also. So now we have discussed close to 3 to 4 questions on for this hedging because of the importance. So I believe now you can easily able to solve majority question. So I request you to practice the next question. So you can just start for question number 3. This came for June 2024. Question number 3, this came. So what is speciality of this question? What is speciality of this question, friends? This question, there is no market price on expiry is not given. Now you are very well ahead of all the option strategy. So you can easily able to solve this. So they given the data. So I will read the data for you. Sontex Limited is an Indian firm, need to pay Japanese yen 1 crore on 31st August. In order to hedge the risk involved in foreign currency transaction, the firm is considering two alternative methods. One is forward market correct and currency option contract. So very two things only, forward market and options. So two things only. Following details are given below. See the point, they tell the exchange rate very clear. JAY by INR. That means denominator is INR, but you have to pay what? 1 crore JAY. That means it is a indirect quote. So you are now expert on direct quote, indirect quote. So you understood the case. So in this case, it is your INR 1 crore is coming. here for n, but n is numerator, so it's an indirect code. So all the indirect code concept will come. Spot rate, forward rate is given. So bid ask rate, two-way quote only they given. Strike price, only one price they given. They given both call option and put option. So you have to think which one is correct. Call or put. We learn now concept. See, you have to get here JY. JY only we have. So JY we have to buy. So it is call option. See the point. See, now you are very clear. It is call or put, how to select it. You want JY. So if you want to, because they have to pay. So if you want to pay JY, you need it. So call option is relevant day. Call option rate is 0.047. So now we have, for exercise the balance, the forward rate. So they are asking forward market cover and currency option contract. So I request you have to practice. Please friends, in this revision session, I want you have to do it very fast. I think it is very easy. Forward 1 second or 1 minute maximum. For there is no market price for options here. So it will come our good morning question concept. You have to assume it is exercising. So two outflow will come. Your exercise price will be one outflow. Another one will be what? Your premium. Only the point is what? They have given in indirect code. So you have to divide. That is the only difference you have to do it. So the test is not for any bigger calculation. It is just because they given indirect perspective. So I request all of you to try and practice. All the best. Come on, friends. You can able to practice very well. I want you to try. See, though they are given excess balance is covered JY, it is given for confusion. There is no contract at all. Full amount will go. There is no contract value is given. So you can go for it. There is no balance. That is just like when there is a contract only, you have to go balance. But here there is no contract amount is mentioned. So that line have no relevance. So shall I start or will wait for you to come, start and complete? You try. It's not your ICMA study material question, a different model question. Majority twist are there, majority. Only one true I have given. It is an indirect quote. Come on, friends. Let me try. Come on, friends. So hope all of you completed. So it is 1 crore. We can do very easily. So forward contract. So what is the outflow, friends? Yes, sir. 1 crore divided by, see, it is a payment. Payment, what is relevant? Bid or ask? See, if you go through, no need of anything. You can go with our table, which is, if it is payment, it is ask rate, but it is an indirect code. So 1 divided by bid rate. So you have a 1 month. Why I am going every time back before? To make you confident. Any type of question you can able to apply. So 1 crore divided by 1 divided by, you have to go for forward rate. So you have to take which one? 1.5726. So 1 crore. 1.5726. Is it this amount? 63 lakh 58,000, correct? 896. This is the outflow under forward. 1 minute is over, 7 mark question. So this is the specialty, friends. Now currency option. So currency option, how it will be, friends? What is the outflow? Anyway, you are going with a 1 Japanese yen, correct? So what is the price to be outflow? Outflow means you are exercising. So 1 crore, you are exercising at what this price? 1.5855. This is the exercise price. So this you have to make it. So 1 crore, 1.5855. For this, you have to add the premium. What is the premium amount? 1 crore into 0.047. This you have to divide by 1.58. Premium you have to pay in the spot. So you have to take the spot price 1.52, 1.5225. That's it. So 1 crore into 0.047 divided by 1.5225. My dear friends, 7 mark, one small point. I think I have taken. Is it correct? This one is correct. So what is the total outflow? So you can just check it, which is best. This is how you have to approach. So now, my dear friends,
Sir,
here, once again, if you go through here, they have already given the amount in JY only. Your study material is taken this amount as rupees, accordingly they sold. So this premium calculation alone in your study material is wrong. They have taken directly multiplication. So we have taken properly because they have given in that, not study material, it is a previous year question. So we have taken 1 crore into 0.7. So every JYY you have to pay 0.047. So it's JYY only. So you have to pay now. So current spot rate is relevant. So this is how you have to approach. So now the decision is what? Lower the outflow, better the option. So decision is what? Forward contract. See how fast you are able to complete. This is what called practice. When you do more practice, you can able to save the time. 7 mark question you can save in a bigger manner. So this is how you have to approach. So please take your time and complete, my dear friends. So my dear friends, now we go for another June 24. So we discussed both the December 24 question. Now we are doing the second June 2024 question. It means all the recent previous year question we have already discussed. Now Ajanta Pharma Limited has acquired a export order for 10 million for formulation of Tanpi Private Limited, a European company. The APL has planned to import bulk drug worth rupees 5 million from Goodgone Limited, a company in UK. That means, see the point 2 case has acquired an export order for 10 million. Also planned to import for what? 5 million. Both are in rupees. That is your home currency value. 10 million from which company? European company. This is in the UK. The proceeds to be realized after 3 months and payment after 6 months. This is very important. That is your export, you have to get the payment within 3 months, but import you have to make after 6 months only. That is a very important point. The invoice of this export and import can be done in any currency. That is, invoice you can do either in dollar, euro or pound at company's choice, following the market quotation. So market quotation is given. See, if you go through expression, all you can make, they're given first dollar, euro, pound, everything direct quote is given for foreign currency. Now a premium is nothing but what is the forward rate. If you have to adjust the premium rate, then you will get the forward rate after a future period. As a financial consultant, what recommendation you make agenda for invoicing which currency export, in which currency for import? So both export and import you have to do. I know you are ready. This is also we can do very easily. So first we can go for export. What is the export value, friends? 10 million. So this is the export value in rupees. You should be very clear. You are making the payment after 3 months. This is the main point. So you can go for each currency. All the three currency they are asking. So what was the currency? Dollar. Then you can go for euro. Then you can go for what? Pound. Now, what is the invoice rate? Now, very, very important. See, dollar, what is the invoice amount you have to make it? Tell my dear friends, when you will give the invoice? Invoice you will give when you are getting the payment or on the spot when you are making the sale. When you will give the invoice to the client? Now, you will give invoice now. Payment only you are getting a future. So invoice amount, the relevant is what? Spot rate. Invoice, the relevant is what? Spot rate. So what is the invoice you will take it? See, 10 million you have to take for dollar. Very, very important. See, now the point is what? Here the currency is rupees, but rupee is in all the case it's numerator. So it is a indirect quote. It is a indirect quote. See, you want to get the dollar. So if you want to get the dollar, if you want to get the dollar, the bank is selling the dollar. So the rate at which bank sells is called what? Ask rate. But it is an indirect quote. So you have to take what? Bid rate. You have to take what? Bid rate. So generally we can able to get it very easily. That is dollar perspective you are thinking. So dollar only. So you have to get the dollar. So you will get the dollar in future. You will get the dollar in future. So you will give to the bank. Bank is buying. The rate at which bank buys is called what? Bid rate. Bid rate only. I have done payment perspective. It is a, not payment. It is a receipt only. So receipt na dollar you will give to the bank. So bank will give you the payment. So the rate at which bank buys is called what? Bid rate. The rate at which bank buys is called what? Bid rate. But it is an indirect quote. So you have to take what? Ask rate. So your ask rate is what? 82.2. So what will be the amount? You have 10 million divided by 82.2. This is your invoice rate. 1 second. See, my dear friends, one small point. We are thinking rupee perspective only. We in between we just went to the dollar. See the currency expression here. It is rupee only. So rupee is a numerator. So rupee is the indirect quote. So if you are giving bank a dollar, rupee perspective, what is you are buying? So rupee perspective only you have to think. So rupee, if it is your dollar, you are giving rupees you are buying. So rupee perspective only you have to think it for converting. So rupee, if you are buying, bank is selling. The rate at which bank sells is what? Ask rate. So ask rate you have to take. It's an indirect code. So you have to take the 82.1. This is the only discussion we have given in the beginning also. But in between we moved into dollar. That is why I'm giving very clarity. No need to make. That is in between the dollar perspective discussion came. So I just changed. Now I am repeating once again. What is a currency we have? We have rupee. So you have to think rupee perspective only. Question, what is the currency is given? Rupee. Question, what is the currency given? You have to think that perspective only. So rupee. Rupee, what is the position? In future, you will get the dollar because an export. So when you are getting the dollar, you are giving to dollar to bank. But we are thinking rupee perspective. Dollar is giving, rupee is buying. So if rupee is buying, the bank is selling the rupee. So ask rate. The rate at which bank sells is called what? Ask rate. So ask rate only rupee we want. But rupee is a numerator. Rupee is a numerator. Since rupee is a numerator, we have to go for what? 1 divided by bid rate. So what we have done? 10 million divided by 82 point. We have one speciality. One currency you done, balance everything same perspective only. What is balance? Same thing. Balance everything 1 divided. Here it is euro. You take 77.15. Pound also the same thing. You have to go for divided by 100.65. I am repeating once again for everyone benefit. The rupee expression only given in the question. So we have to think rupee perspective. See, you are an exporter, you will get the payment only. So that dollar only will give to the bank. So dollar you are giving to the bank, bank is buying bid rate only. But rupee only expression we are thinking now. So dollar is giving, and that means you are getting what? Rupee. So rupee bank is selling. The rate at bank sells is called ask rate. The rupee is a numerator. So that is the point. The point is what? You want to get the invoice amount. Balance step is very easy. You want to get equivalent amount in particular because you want to know which option is best for you. You want to know which option is best for you, which currency is best. Obviously, it is a receipt. Higher the one is best. So now we'll go for what is the exchange rate after 3 months. Why it is 3 months, friends? Why it is 3 months? Why it is 3 months? Very good. It is 3 months because the question they tell that you are going to realize after 3 months. You are going to realize after 3 months. Hope all of you are clear. The question specifically tells you are going to realize after 3 months. Now I am going to find up. Answer is getting. See, now the currency is in dollar. See very well. Now this invoice amount in dollar or rupee. Invoice amount we converted into dollar. So actually this amount is in what? Dollar. This amount in what? Euro. This amount in what? Pound. So now you look here. This is already dollar direct quote only. Here dollar direct, euro direct quote. So now the steps are very easy. Now you can do directly, no complication. So your annualized premium is 7%. Now you think you are getting dollar. So you will give to the bank. Bank is buying. The rate at which bank buys is called what? Bid rate. So bid rate is what? 82.1, 7% premium. So 7% is for annum. So what is the exchange rate after 1 month? 82.1 into 1.035. Very, very important. We are just adding 7%. The 7% is for 1 year. 7% is for what? 1 year. So 7% is for 1 year. You are getting after 3 months. So you have to take for 3-month rate. 7% into 3 by 12. What you are getting? 1.0175. 1.0175. All of you clear how you got this 1.0175? Do you want working note? That is 7% is after 1 year only. You have 3 months only. So 7% for 1 year now. For 3 months, what will come? 6 months, 3.5. Again, 1 by 2, 1.075. So this is your exchange rate after 3 months. Now, what will be the amount receivable? Now, amount receivable after 3 months. Your answer is getting now, my dear friends. Your answer is getting now, my dear friends. Amount receivable after 3 months. See, you have invoice amount is in dollar, exchange rate also dollar after 3 months. So you got 1 lakh, 10 lakhs, that is 1 million, 10 lakh, no, 1 crore, 1 lakh 75,000. 1 crore, 1 lakh. This is option route. Now, euro, you see what is going to happen. Your exchange rate is 77. See, one thing you have done, balance everything is easy. It is 6%. So, 6 months it will be 3%. So, 4 month 1.015. Correct? 3 month 1.015. That is 1.5. Now you see here which is best, which route is best. See, here you are getting 1 crore 1 lakh 75. Here you are getting 1 crore 1 lakh 50. Which is best in this case? So far dollar invoice is best because dollar is getting appreciation. So this is a very good strategy. Our study material does not have this type of question. So it is a good exposure for you to learn this kind of question. I hope you are understand what we are doing. That is, you are done a amount of 10 lakh in your perspective rupee, but you want to get a currency benefit. So what you are doing, you are trying to check what all the perspective will come if I issue the invoice in dollar. What is the benefit if you issue in dollar? If you issue in dollar your invoice after the 3 month, you will get the, if you issue in dollar after 3 months, you will get the receipt in dollar. If you issue in euro after 3 months, you will get in euro. If you issue in pound after 3 months, you will get in pound. So what will happen? If dollar is appreciated, you will get more amount. Accordingly, you will get the benefit. So this is what? So this 83.5 is the dollar amount after 3 months. 78.3 is the pound rate after 3 months. Sir, how you got this after 3 months? Because current spot rate is given here. This is euro. Current spot rate is given here. They given what is the appreciation premium. So we just changed. It is for 3 months. So this is for annualized for a year. We just changed it. How we changed it, sir? 7% is for 1 year. 3 months it is 1.75. Same way, 6% is for 3 months. We done for 1.5. So we get what number? 82.1 into 1.1 means the principal amount here. In your calculator, it is easy. You can take 82.1 plus you can just enter 1.75%. You will get the number. Are you clear? The same way, can you please tell me what will be for pound? The same way, what will be for pound? 100.65 into the appreciation is 5. So if I am not wrong, 1.0125 because 5%, 125, 5, 2.5, 125. Clear? Pakka? Yes. So this is how you have to approach. Now, if you go for it, you see this is pound, this is pound. So pound, multiply direct quote. So you got the number. So which is the best? Invoicing in dollar gives highest amount. Thus, it is better to invoice in dollar. Same way we have to do for what? Import. Now you are good in concept. You can do import in very easily. I hope all of you concept pakka. Only you may have a small starting issue on this invoice amount that I have already clarified. Rupee is given, you have to convert into dollar. Rupee is a numerator, so indirect quote you have to divide. Rupee you are buying, so bank is selling. So right at which bank sells is called ask rate. Because it is an indirect code, you have to divide by bit rate. Hope you are clear. Now we can go for import. What is the import amount? 5 million. This is not 3 months. This is after 6 months. So for me, it's very easy. Shall I start or will you try? It's ulta will come. So how you have to make? It is 5 million. Divided by, again, rupee. Here you have to make. So here, what happens for rupee? Because you have to buy dollar. So you have to give the rupee. So bank is buying the rupee. It's a bid rate. So you have to go for 1 divided by ask rate. So one concept you are clear. Ulta, it is very easy. So what is the amount you have to divide? 82.2, correct? Next it will be divided by 77.2. 100.75. Now again, what is the exchange rate? We know you are getting, so you want to buy. Bank is selling, so bank sell is ask rate. So directly we can go for it. 82.2 into 1.0175. 77.2 into. So here, very interesting point. It is not 17, it is 6 months. So 6 months, you should not take this, no shortcut. It is 3.5. The reason 3.5 is what? 7% is for annum. So 6% is 3.5. So the rate will be changing. Here, 77.2 into 6%. So you have to take 3%. Because it's a 6 month, it will change. Next, 100.75 into 5%. So it is a 3 month, 1.025. So what is the amount payable? This is the invoice rate. This is the price. So which price is best? See, best will be lower the outflow. So best will be what? Invoicing, which is the lower pound. Invoicing pound will be best as lower the outflow is better the option. I will tell you one shortcut method also. See, you will get ulta ranking. Here, this is best, this is next, this is next. Here, this is best, this is next, this is next. Because currency ulta, buying, selling perspective. So you can ensure that you have done in a correct manner. Your study material note not given any working note, anything, but we discussed in a your this is a previous year question. Suggest answer, not given proper working note. We discussed that in a proper method so that you can get the clarity very well. You can able to get the clarity very well. So hope all of you are clear. Hope all of you are clear. So please take your own time and copy, friends. Go for another previous year question. So this session, we are trying to do as many previous year question solution. So we are done all the question of December 24, June 24 from Forex, and now it is December 23. December 23, this question came as a ditto question from CA final May 23. So they copied from CA final 23, both the questions, 6 and 5, both are say taken from CA final. So this is your favorite question on what? Hedging. They are asking on hedging on what? Forward contract, currency futures and hedging. So here, instead of option, they are asking what? Futures. So futures also one of the tool for hedging. That is the reason I am doing this question. What is the future? Same perspective only. The point is what? You have to pay margin money. What is margin money? You have to pay in advance. That is the only difference. So we will get one more benefit of hedging with futures also. That is the reason we are doing this. But this is already you have done, so you can able to do this very fast. I think I not even want to help you on this question. We did n number of questions, so I will give you an overview. Let's see how many of you will complete. So shall we start, friends? So Swadesh is an export-oriented unit. It's in a currency of importer. It is expecting. So they are going to get a receivables. US dollar 2,40,000 in the month of May 23. Exported in May 23. The following. See here, there is a contract. Load says is coming. 6,40,000 is in the rupees. Load says spot. See the expression they given very clear. See the amount they given 2,40,000 in US dollar, but expression in currency they given US dollar by INR. So tell my dear friends, is it a direct quote or an indirect quote? It is an indirect quote. So accordingly, spot trade 1 month forward, 3 months. For confusion, they have given 1 month and 3 month both. Let's see which one we have to take it. Currency future for May month, June month, both are given. So here the following are available for 1st May only. So you have to go. Initial margin May month, we have to pay 15,000. If it is August month, you have to pay 26. Interest rate both in India given for May and August. On August 2023, that is your expiry. So what is the period for that? August, you are in May. So May, April, May, June, 2 months. That is June, July, August. So 3 month period is there. Spot rate on expiry. Here also indirect quote is given for currency future. That is future contract. You know, whatever may be the price, you have to go with the price. So which is 0.0126. And future rate, that is spot rate. This future spot rate will be useful for what? No hedging, because we discuss. You can recall the theory concept we discussed for no hedge. What is the theory concept we have discussed for no hedge? No hedge. Take the spot price on expiry. So that is the reason they have given spot price is 0.016 and currency future of the date is 0.015. But this is on the date. But we have already May month, June month exchange rate is already given. So this is the June month expiring rate is already given there. Suggest a suitable approach that would most advantage is an export, so cash inflow only. Higher the inflow, better the option. Higher the inflow, better the option. So first they are asking forward contract, then they are asking currency future, then they are asking no hedge. Can you please start, friends? So please start first to forward contract. You can try. See, they're given 1 month and 3 month also. Which is relevant? 1 month is relevant or 3 month is relevant? So confusion, they're given 2. Which is relevant day? 3 month. Correct. Why 3 month is relevant day? Today you are on May 1st day. Your contract is expiring on what? 1st to August. So 3 month time. So what is the point? May, June, July. So that is a 3 month period. That is June, April, May. June 1st, 1 month. July 1st, 2 month. August 1st, 3 month. So that is a point you can work out it. Come on, friends, please try. I have given. How you know it is August 1st day? They are given expecting a receipt on 1st August. Expecting a receipt on 1st August. It is given in the heading itself. So 1 month forward is given for confusion. Relevant is what? 3 month forward. 1 month forward is given for confusion. Relevant is what? 3 month forward. Come on, friends. Direct quote over here, no confusion, friends. Two-way quote is not there. So no need of bid or ask and all. So it is an indirect quote, so just divide. That's all. It's an indirect quote, just divide. So 2,40,000 divided by 0.0123. That's all. 0.0123. That's all. Yes, what is the number? So congrats for those who are all tried. So receipt tender forward contract. It's very small question. So I don't want to take any time from you. So 2,40,000 by 0.123. The reason we have discussed why 123. So you will get an amount called a 1 crore 95 lakh 12,195. The number of contract. See here, they said how can you get the number of contract? Very easy. See, 2,40,000 is the US dollar. So the contract size is given here in rupees. We discussed a good morning one question from our ICMA study material that is also in our workbook, which is given in the currency pound. But here it is in rupees. So what you have to do? First, you have to convert this 2,40,000. Your spot rate is 0.0125. What you will get? 2,40,000 divided by 0.125. What you will get? 1 crore 92 lakh. This you have to divide with your load size, which is 6,40,000. Why this load says your margin money, everything will be on that basis, 6,40,000. If I am not wrong, you will get 30. If I am not wrong, you will get what? 30. Are you clear, friends? Now we have margin money we have to take. Which margin? Because we are doing currency future now. Currency future, first time we are doing our problem. Our study material, there is no problem. So this is from CA final our institute took and it came for June 2024 exam. So how you have to approach, friends? Your contract is expiring for August. So you have to take for August. August, this margin money for every contract. So you have 30 contract. So you have to take 30 into 26,000. So 30 into 26,000, you will get what? 7,80,000. Then receipt, you know, which is already you have that amount for right now. See, this is the currency future which is available in the market. So we have to take the rate for the May. Future rate for May, that is right now is 0.0126. So you can take that amount. So you will get the amount for receipts. This interest cost already you know, that is you have to pay the margin money now. You have to pay the margin. So opportunity cost. So this interest cost, for time saving purpose, I am not doing it. So interest cost is nothing but opportunity cost. That is 7,80,000 margin money you have to pay now. For forward concept, do you want to make any money now? Forward, you don't want to make any money. No hedge also, you don't want to make any money. All are outflow under future. So you want to take everything into future value. So future value, if you want to take this amount, you have to take the interest cost. So this is an opportunity cost. So why it is reducing? Because opportunity cost is a cost, balance all are inflow. So you're getting net inflow. You're computing what? Net inflow. So this is your net receipts. If there is no hedge, then what will be the amount? If there is no hedge, then the amount will be what? So which is best? More receipt under forward contract. So best is forward contract. If no hedge, why I took 1.0126? See the question. They tell very clear. On 1st August, the spot rate is 0.126. Are you clear? Spot rate is 0.126. This currency future is not relevant. That is why we are not. So congrats for those who got the correct answer. So what is a future specialty? You will have the margin money. You will have the margin money. That is a specialty for futures. So with this, all the hedging concept we have discussed, options, futures, then money market, forward. Majority of question, forward is coming. Money market also coming majority of question, but this question it is not. Here we did it no hedging also. No hedge, it is not the solution we have done, right? So the question also. So MQP question, which is for June 25. Already we did our 6 or 7 hedging question. So I don't want to repeat this question, solution also available. So what is the question? They're asking forward market and money market. So very easy. They are asking for you all the methods, so you can able to work out on this. Pros, right, also there. So we have did all the question which is no solution is available. June 24, no solution is available, we have done. December 23, no solution is available, we have done. Now June 25, MQP is already released the same point, so we don't want to make it. But I request you have to practice this. Sometime MQP ditto question comes. Now we do next MQP question, which is one of the easiest question. So you are getting a different model. Why I am selecting this question? Because we will get a interest parity theory revision also. We got revised in this session majority area except arbitrage course of action and interest parity theory. So question number 8 is giving that interest parity theory. Though it is a 7 mark, we can complete very fast. So with your permission, we are starting. US dollar rate selling in India is 55.5. You know, rupees 55. So that meaning is what? Rupees 55.5 per dollar. If the interest rate for 6-month borrowing in India is 10% and USA is 4%, examining US dollar will be premium or discount in Indian market. Expected 6-month forward rate for US dollar. So we can answer it is a premium or discount. With interest rate itself, we can tell it is premium only, because if their interest rate is less, India is more, it will be premium only. But we can prove it by doing the second part. What is proving it by second part? That is, we can do what is the forward rate after 6 months, so that you will get a better clarity. So with your permission, we will start. Which is the question? So first one, it is a theory question. We have already answered, but we'll prove with the second part. So you have learned the concept. Forward rate is equal to spot rate into 1 plus home currency interest rate. This is the interest parity theory concept. 1 plus foreign currency interest rate. So what is the expression, friends? Rupees per dollar. So rupee is a home currency. So your forward rate after 6 months. So forward rate after 6 months will be, your spot rate is what? 55.2 into 1 plus home currency. See, your India rate is 10%. You want 6%, 6 months. So 6 months, 10%. If you take 6 months, it will be 1.05 divided by 1.02. So what will be the rate, friends? See, you are getting excess. See, this first question, what you can see earlier $1 you will get only 55 rupees. Now $1 you're getting 57. So they are asking dollar is a premium or discount. So we can say dollar is at premium. See, already I told don't want to do second part. There is a shortcut is there. What is the shortcut? Interest rate in US is lower than India. The reason is what? Interest rate in US is lower than India. This is the reason. Or interest rate in US lower. US you can return is what? Foreign currency. So this is the shortcut method. So we have already proved that first, but we have not written. I want you to prove by doing forward rate because you will be more clarity if you do forward rate. So exam purpose, no need to wait for this to solve. You can just check the interest rate. Your numerator currency interest rate is more, then the answer will be increasing. Numerator currency interest rate is less, then answer will be decreasing. So this is how you have to make. Same question, interesting point. If they ask for rupee, now ulta will come. In this question, it is come dollar is premium. If for exam purpose, if they are asking rupee, then the answer will be what? Discount. So you have to be very clear for that. So it is also 7-mark question. You can do. Calculate the rate of forward premium or discount. So they have to do premium or discount, that is appreciation or depreciation. So see here they are not specifically asking which currency, so we will do only for dollar. They will not specifically asking. So what is the formula? We have did already one question, forward rate minus spot rate divided by spot rate into 100. So what is the forward rate? 57.13 minus 55.5. 55.5 into 100. So if it is a positive, it is premium. I reduced in 2 decimal. You can go for 3 decimal also. So this is how we have to approach, friends. So you can take your time and complete. See, 10th question, it's a arbitrage question on what? 3K. So rather than going this 10th question, what I'm going to do is I'm going to give a proper revision of all the 3 type of arbitrage. So which will helpful for you to score any type of question. Actually, here came the arbitrage of what? Interest rate in pound is 12%, New York is 7%, pound sterling rate 1.8. Is there any arbitrage? So here they are doing what? Theoretical forward rate concept, correct? So it is very easy only. So we have 3 type of arbitrage question are there. What are the 3 type of arbitrage question is there? First type is direct quote is not equal to indirect. Second case, cross rate is not is equal to exchange rate in the market. Third case only, theoretical forward rate not equal to forward rate. So this question is for what? Third case. So please revise our regular class 3 concept. We discuss all the 3 differently and we have highlighted the question which are all the case 1, which are all the case 2, which are all the case 3 in the regular class also. So please ensure that all the 3 case of arbitrage you are clear. What is the case 1? Direct quote not equal to indirect quote. The next one is what? Cross rate is not equal to exchange rate. Third one is theoretical forward rate not equal to forward rate. Correct or not, friends? So in this question, this is for what? Theoretical rate is not equal to forward rate. So we can just go for it. The last question. So question number 10. So what is a theoretical forward rate? Theoretical forward rate, spot rate is dollar is a home currency. So 1.95 into So 1 year only. So you have to go for 1 year. So dollar rate. So what is a dollar rate? It is coming 1.07 divided by 1. This is the theoretical. That is interest parity theory. Now only we discuss spot rate into 1 plus home currency interest rate divided by 1 plus foreign currency interest rate. So here the expression dollar is a numerator. So that is why we taken that numerator currency, home currency, numerator currency, whatever the way. So 1.95 into 1.07 divided by 1.12. In the regular class we discuss all the method, but we have this case only came. So you can able to be very clear for that. So we got 1.863. Dollar 1.863 per pound. What is the forward rate? Dollar 1.87. So what is the point? Theoretical forward rate is less than forward rate. So can you please recall what is the one line we have learned for this? Money will flow into home currency. So I hope. So I'm telling very shortcut. So the point is what? What is the step? If you want to money will flow into home currency, you will take a loan in foreign currency, you will convert into home currency, deposits on maturity period, what you will do? You will convert the loan. By this course of action, you will get a profit. So here, very unlucky question. Why I feel this is not a proper exam question, because they are not given any amount to assume. So exam perspective, if it is a question, they will give you what? Assume you are starting with either, in the classroom we have discussed, either 40 lakh or 83,312. We did 4-3 question. One question I remember I am told. So here they are not given. So shall I give you some a random number and we will try and prove it? Yes. So money will flow into home currency, correct? So which is home currency? This home currency and all technical term we used. See, dollar is a numerator. So what you will do? You will borrow in home currency in this numerator currency only. So you will borrow in pound and deposit in dollar. That is the point. Why home currency dollar? Because numerator, that concept we dealt with it. So shall we clear? So borrow in pound, money will flow into, one second. What you have written in the class session, friends? Money will flow into, okay. I have written here, money will flow into, here it is less than only. So foreign, borrow in dollar and deposit in pound. See, my dear friends, there is a one speciality in this method also. Even if you assume wrongly, final answer will tell you whether it is correct or wrong. That kind of speciality also we have. So money will flow into foreign currency. So if you want to follow into foreign currency, you have to first borrow. So your home currency and all expression only the flow. So you have to make it. So in the regular class, we discuss very well. So in the revision session, I have to make you as simple as it is for you. So very simple. Theoretical forward rate is less than forward rate. This is, suppose if theoretical forward rate is great, theoretical is more, money will come to home. So more theoretical means home, less means foreign. Correct? So you can counter check your class workbook and you can confirm the same. Please check your class workbook. If you have any doubt on this, we have given a wonderful chart for this also for you. Are you confirm? Confirm? Okay. Chart, did you go through, friends? Shall we start, friends? Yes. So you don't want to even revise. I will give you the single point. So theoretical forward rate is great. Money will bring to home currency. Theoretical forward is less. Money will grow into foreign. So you have to borrow in dollar. So shall we assume 1 lakh? I told practically the question will give you the proper amount. Here it is not there. So we will go with a number. Shall we? So we will go with borrow dollar 1 lakh. Now at dollar rate is what? 7%. Correct. So borrow 1 lakh at 7% now. Now what you will do now? This borrowed money, you have to convert. So we'll go step by step. We discuss in our regular session. So convert into foreign currency. So now you have dollar with you. So you have to check the exchange rate given in the question. They are given dollar 1.9. See the point here, dollar is there. So dollar is a numerator, so it is an indirect code. You have to make it division. So no need of confusion, only one code only. So we in the class we did two-way code problem also. So dollar 1 lakh, it is an indirect code. So you have to done with the spot rate. What is the spot rate? 1.95. So what will come? So this is the amount of GBP you will get it. Now deposit at pound GBP, that is foreign currency, at what is the rate? At 12% per annum. So you deposited this amount. So this is what action now. The regular session we did, we'll go that step so that you will get a better clarity. Now action on maturity. Realize the deposit with interest. So you will get what? See, it is 1 year only. So this is the amount you deposited. After 1 year, 12% is the interest rate. So with the interest, you will get this much money. So what you have to do? Convert to home currency. Now you have pound. So you can directly multiply 57435.89 into what is your forward rate after 1 month? 1 year, it is 1.87. You can directly multiply because GBP in denominator, so direct quote you can multiply. So if you multiply 1.87. Now settle the home currency loan with a interest. I'm doing it shortcut, or else I will give the working note properly. You taken a 1 lakh loan, you have to pay interest of 7%. So with the interest, how much you have to pay? 1 lakh. So what is the gain on arbitrage? The difference. This much money you got it. You have to settle only this much. The gain is 405. This is in dollar. That's all. Answer is over. So we assumed 1 lakh as you commonly told. This is your MQP set to. They assumed a 1 million. That is one more zero. So they will get one more answer. That is, we got 405.12. They will get 4051. So if you go through your MQP, I have opened that MQP also to boost your confidence. They might have been done a lengthy method you don't want to follow. Final answer 4051.28. The same answer only will get. So whatever may be the question, if you follow the shortcut method, chart, everything we given in the class, you can able to crack it very easily. Questions and all very easy, only you have to practice it. That is the main thing we have to make it, my dear friends. So that should be very important point you have to keep in mind. So please take your own time and complete. So though we have did this question, maybe this model type of question only will come, but in the regular class we discuss 3 model. So this is a standard case which earlier 12 syllabus and 16 syllabus and all previous year question came. But so far 22 they tested more on hedging. That is why we did more question on hedging. But very lucky we are able to do this kind of question, arbitrage question. We are able to do interest parity theory. And you know one thing, in the regular class we discussed one concept called international capital budgeting questions. But that is, we have taken safer zone from 12 syllabus. But there is no MQP, there is no things. So we don't want to work on it. So hope all of you are clear. So please take your own time and copy, friends, fast. Now, my dear friends, coming to, so we have discussed all the MQP question. Now, when it comes to revision, as you know, we have 14 mark pakka question from Forex. Apart from that, 2 to 3 question you will get from what? MCQs. So MCQ mostly testing on interest parity theory, reverse calculation, one question normally coming. Spot rate, interest rate will be given. They will give you what is the forward rate. Or sometime forward rate, spot rate, and one interest rate will be given. They'll ask you what is the other interest rate. Or sometimes they'll give you interest rate, forward rate, everything will be given. They'll give you time period. So that kind of one question is asking. Another one they will ask you cross rate. Sometime bid and ask comparison they will given. So this is the area they are asking for 1-2 mark question. So I have given you our class workbook question set. This is your ICMA steady metal perspective also you can see going through. This is an overview. What are the area in your Forex for your syllabus? So arbitrage, cost of action, direct quote, indirect quote, refer. I have told you the case one. Your steady metal also 7th, 8th question. Arbitrage, cost of action, cross rate. So we have done this question now. Theoretical forward rate, but we have done though. Here is the main point. Hedging through forward contract. We discussed different case of question, and also there is a question when you cancel the forward contract. In the regular book, you can find out the question of question. This is also one time previous year question for 16 syllabus. That is, if you cancel the contract, then you will have the penalty, and what is the right on the expiry only will take it. So we have only one question we discussed through. Then we have money marketed. This is discount offer, that is forward. If you pay immediately, you will get it. This kind of time period we have discussed. Money marketed is a very good question. So we have focused this area. This is the yellow color which is more highlighting for you. Comprehensive hedging with this is what we focused mainly today, because every time this question is coming, money market forward option. Even today we have discussed one CFL question on what? Futures. Apart from international investment, I told they are not generally discussed for the exam, but in regular class we discuss, that is capital budgeting. We have two methods: home currency approach or a foreign currency approach. Home currency approach na, what is your investment? You have to convert into home currency by exchange rate, then you discount with the home currency discount rate. But if it is a foreign currency approach, what you do? You don't want to convert the currency. You can take old foreign currency inflow and outflow. Only you take discount rate relevant for foreign currency. You can just revise in 5 minutes those topic, but there is no question and there is no question in your ICMA material, no previous year for 22. That is why I am not discussing in this revision session, but in regular class we go through that. You can revise in very shorter period. So general question, this is what exchange rate. You have to deposit in a X date, but you are not able to maybe because of strike or some other reason. You are doing after a few days. So what is the loss going on? Then exposure, netting control, we discuss MQP question also. So this is the main area coming SAT. So I believe that majority area of SAT we are covered and we are very clear on this point. See, my simple request for all of you that Forex, when question is coming, please try to understand the question very easily, because if you understand, you can solve very fast. It will take less than 10 minutes only. So you can able to score good mark. Mostly this hedging question, without our discussion, no question will come, because we didn't that much hedging question. Then arbitrage in this MQP, they given clue for what? On theoretical forward rate. So that also we have revised. Though we revised the theoretical forward rate is less than, We have discussed how to approach theoretical forward rate is greater than. If theoretical forward rate is greater than, money will flow into home currency. What is the step for that? You will borrow from foreign country, you will convert into home currency, you will deposit here. On the maturity, you will realize the deposit with interest and you will convert into foreign currency, and the difference will be your gain or loss. So we discuss such kind of question in the class also. You can refer the class question 53, previous year question 25. Also, we have discussed in the class. Then direct quote, indirect quote, bid day, appreciation, depreciation also MCQ. This is the MCQ model question you can expect. Arbitrage question also, the interest parity theory I told, directly or reverse way. Then margin money question, call put question, kind of question also can comes for exam. So if you go through properly, I believe that you can able to revise before the exam 30 minutes this entire topic. You can able to score good mark for this. So you have to utilize the simple shortcut method, that how to approach the direct quote, indirect quote, which we discussed in the beginning of the video. So you have to understand when it is a direct quote, when it is an indirect quote, two-way quote. But majority previous year question, they are not testing that much, but still you can able to go for it. So clear? So with this, we are just going for a break for the session. We will continue with another topic. Now this session is for revision, ends for